Good afternoon, everyone. I'm excited to welcome you to our highly anticipated webinar, Navigating Tax Season for Artists and Content Creators. My name is Lorena Guzman Diaz. I'm an associate at Weissman Law, and it's my pleasure to help guide you today through our very important discussion, which is dedicated to unraveling all of the complexities of tax essentials for those of you in the creative realm. Today's virtual seminar is part of our ongoing series of online panels and webinars, which are dedicated to equipping artists and creators with a lot of essential legal and business knowledge. Today, we have a fantastic lineup of knowledgeable speakers who will address key topics that matter to you as an artist or a content creator. So first of all, we have Adam Weissman, the founder of Weissman Law, and the dynamic duo, Garrett Alexander and Joseph Lengel from Game On Financial, both of whom are very experienced in managing the financial intricacies that are faced by creative professionals such as yourselves. Just a quick letting you know how it's going to be structured. So today's session is structured into a 30 to 45-minute panel discussion where our experts are going to share their insights on really important tax-related aspects. And then after the discussion, we'll open up the floor for a 20-minute Q&A session where you'll have the chance to ask questions and engage with our speakers. So as always, your participation and questions are highly encouraged. Before we dive in, I do need to disclaim that the information presented here today in this presentation is for informational purposes only and should not be considered legal advice. So please consult with a qualified legal professional for guidance on any specific legal matter. Okay, now let's set out into our journey into the nuanced world of taxation tailored for the creative minds. Adam, the floor is yours.
Nice to see everybody. As Lorena's mentioned, this is our third installment in a series of webinars that we're going to be putting on throughout the year. So for the first couple webinars we had so far, we brought in a bunch of lawyer colleagues, people whose practices are fairly similar to ours, or at least somewhat complementary. For today, however, we wanted to bring in some different types of folks, and frankly, people whose areas of expertise are way outside the norm of what Lorena and I do at Weissman Law on a daily basis. We're bringing in two accountants that I've known for a few years and really enjoy working with. They've got a background in the content creator and gaming space, which means they are primed to answer a lot of really interesting questions that a lot of clients ask me that I often can't answer myself. So when these types of questions pop up, I'm very often turning to Joseph and Garrett for answers. Now, whether you are a creator or a gamer or really any sort of creative professional, if you are working with a lawyer to get started on a lot of your stuff, one of the questions that lawyer should be asking you is, hey, do you have an accountant that you work with? Because especially at the outset, when you're putting together your business, when you're forming your company, when you're deciding how you're going to pay people, when you're deciding how you're going to get paid, when you're deciding what kind of legal structure you might want to make your company, an accountant should be there hand in hand with legal, figuring those pieces out. It's pretty rare that I form a company or start advising clients taking on employees without them also having an accountant advising them from the tax and compliance side there. So with that in mind, that's why we brought in these two guys today. Very excited to introduce you both to them. I have a lot of questions. Lorena has a lot of questions. We're going to be going back and forth asking them. I'm sure there are going to be more folks in the audience with a lot of questions. I see my dad in the audience who happens to be a retired CPA. So I know he's going to have plenty of questions for these guys. He grills me on legal stuff all the time. So I assume he's going to do that as well for you too. But with that, why don't we just dive into it? We are going to just ask a whole bunch of questions. Joseph, Garrett, feel free to chime in as you see fit. If you do have questions in the audience, please save them for the end and type them into the chat when we're done, and we'll be sure to do our best to cover them all. So I think the starting point that I want to kind of go out the gate with is, a lot of clients I work with, and I'm sure it's the same with you, if they're coming into the creator space or social media space, for example, there's usually they didn't necessarily wake up one day and just go, I want to be a professional creator. It's more something that tend to happen that they started as a hobby and then moved into professional life once they saw some success. So I want to understand from your perspective, what is the difference between a hobby and a business from a tax perspective? Let's take sort of like an overarching view and then maybe narrow in on stuff from there, because I want to understand what certain people maybe can be claiming on their taxes versus not. And then maybe some bigger pieces from there.
Yeah. For sure. That's a good question. That's probably the one we see the most often in the beginning with younger creators, especially. Um, the important nuance there is first to understand why it makes such a big difference for it to be a hobby compared to a business. Like what are we doing here? Why does it even matter? First and foremost, with the IRS specifically, if you have a hobby, any hobby income is not going to be subject to self-employment tax. And quite frankly, self-employment tax is what kills all of our creators when it comes tax time. That's the one that adds up the most. That's pretty much the point of emphasis when we look at any client is how can we reduce or eliminate self-employment tax as much as possible? That's where deductions and all those things come in. But if it's a hobby, you don't have SE tax to begin with. So early on in your career, you're making a couple $1,000. Maybe you have another job and this isn't what you're living off of. It's not sustaining you, paying your bills, paying your utilities, all that stuff. Uh, that's when it's probably more likely to be a hobby. As you continue to grow, you start making a little bit more money. Maybe you're shifting. We have a lot of creators who come to us and they're initially like, hey, I'm leaving my job, going full time into content creation. That is a pretty good segue into like, okay, now this is truly a business. I would recommend for anybody, if you want just a really quick resource, going to the IRS website and literally, like, if you Google hobby versus business and then just throw IRS in the Google search, the IRS actually does produce a pretty good list. And there are like 8 highlighted bullet points that'll tell you pretty much when it's either a hobby or a business and how to compare the two. That's one of the probably the only times I could tell you go to the IRS website and it's pretty clear and insightful. But that they have good examples and reasoning on like when the determination should be made. For creators specifically, oftentimes what we see the most is they're leaving their full-time job or their part-time job and they're diving in feet first, going straight into content creation full-time. That's usually the pretty clear cutoff that we see. Outside of that, we have some students maybe, if you're a full-time student and you're making a couple $1,000s on the side, it's potentially just a hobby for you. It's reasonable to think that you really spend most of your time as a student. That being said, if you are treating it like a business, we're going to take every deduction possible to eliminate your business income and reduce that down. The bad thing about having hobby income is, although you don't pay SE tax on it, you do not get to use your deductions, your business deductions that you might have, because as a hobby, you just don't get to claim those deductions. So that's kind of where we evaluate it. I will say it is very case by case. So like we were talking about joking before we got on the call, I oftentimes find myself saying it depends, right? Until I see the numbers in front of me and I ask some questions like, what were you doing all of last year, for example? Were you actually a full-time student, a full-time employee? Or was this your main source of income? Was this your actual business that you were operating? So that's really the delineation there. After that, once we make that determination, that's when we get into all the fun stuff, like what's deductible and all these other questions. But that's kind of, Adam, it's a good question because that's the core of like where we begin with any of it is this a hobby or is it truly a business?
Cool. Since you mentioned the word deductible, and I know it's kind of an exciting word for a lot of people, why don't we just jump into that?
Yay.
And would love to get sort of an understanding of, all right, let's say we've established something as a business. Let's use the creator space as a continued example. Can you give us sort of an idea of the deductions and credits that might be available to folks in that space?
I'll let Joseph take that one.
Yeah, I'll take it. I'll take it just because a lot of the creators that we work with, I handle a lot of the bookkeeping side of things and tracking these, so-called deductions that we're speaking of. So, yeah, I mean, it's a great question. That's probably one of the most popular things we get asked is like, is this deductible? Is that deductible? Right. Per the IRS, what basically going back to that, what basically they say is for an expense to be a business deduction, it needs to be ordinary and necessary to your business. Now that is going to depend on your industry. So different industries, obviously what's ordinary and necessary in a construction business is not going to be the same thing that's ordinary and necessary to a content creator. So we do get to deduct different items that maybe in other industries that they wouldn't. The most common ones probably that we see is going to be contractors or employees that are working for these creators, right? They maybe have somebody that does editing for them, maybe somebody that helps manage their creative process in some way, some type of helping person. Most of the time, we're going to see that person just being paid as a contractor, but some of our creators do have them set up as W-2 employees. Softwares and subscriptions, that's going to be a great one. You know, as creatives, they're using all types of different softwares, could be AI platforms, could be, you know, anything like that, that they're subscribed to or paying for that software in order to do their business, to do their, you know, create their content, or as an artist, create their, you know, whatever that may be. So that's a really popular one as well. We usually clump a lot of things into a job supplies or an equipment account. That's going to just depend on what specifically this creator does. But things like, you know, small camera equipment, maybe monitors, maybe keyboards, mice, gaming equipment, lighting, all these types of things are going to be obviously related to that content creation in some way. We'll get into it probably a little bit later on, but travel definitely is going to be a big one as well, depending on, you know, what the creator specifically does. Some of our streamers that just live stream all day, they're maybe not leaving their house much to go to events, but some of our other creatives that make different types of content are traveling quite often. So those are kind of the common deductions that we see. And just to touch on it briefly, I would say the most gray areas that we see are going to be meals, and how to determine if those are business deductions or not. And then probably business and personal use items, the most common one probably being vehicles. And that just is going to depend on what is the creator doing? Do they need this for their business, right? Is it necessary? Or is it, are we trying to get a deduction that maybe we shouldn't be? And so those are kind of some of the gray areas where we really have to dive in and look at this specific case by case.
So speaking of equipment and tools that are essentials for artists and creators, how should they approach depreciation for tax purposes? And what's the useful lifespan that these items typically tend to have?
That's a great question. Yeah. So I'll let Garrett add on to the back of anything I have to say, but to take it off the front, we typically are going to depreciate any assets that are over around $2,500 in value. So anything under that amount, we're typically just going to, if it is a business use item, we're going to write it off just 100% as a deduction in the current year. If it's over that $2,500 value, that's when we're going to get into writing it off and depreciating it, capitalizing it, so to speak. Depreciation for those items is going to vary depending on the exact type of item. Probably looking anywhere from 5 to 10 years, generally speaking, for those smaller items. And the things that we're seeing that we would commonly depreciate for creators would be things like their computer, right? Some of these PCs that they use to game or create content on can be upwards of $5,000, $6,000, $7,000, $8,000. So that's one common one we see with a lot of our creators because they're using one, if not multiple PCs. Office furniture, if it's related to their type of content that they produce, some office furniture can get very expensive. So we do see some furniture items as well. And then the last one that I also, noted was a gray area is vehicles. We do get some creators that do have their vehicle running through their business and it does get depreciated. And again, that's just going to be depending on the type of creator that we have.
Cool. So yeah, sorry, Garrett. Go ahead.
No, you're good. I was just going to add in a lot of cases. So the IRS provides a safe harbor. That's the $2,500 Joseph was referring to. So anything under $2,500, we're just going to expense. And so that's, if you wanted like a pretty clear cut answer, as long as you make that safe harbor election, you're good there. Anything over that, if it's a PC, although we capitalize it, thankfully the IRS rules allow for Section 179 if this is a business. And so even though we're capitalizing it and you would traditionally have to depreciate that over, say, 5 years, we're going to Section 179 it, which means we're going to actually take all the depreciation in that same year. So you actually do get to almost expense it outright. It's from a numbers perspective, you get to the same net result as if you just expensed it. It's just the way you have to show it on the return is slightly different. We do have to capitalize it first, then Section 179 deduct it. That's why once you get to that area, you want to hire an accountant, not because you may even get the numbers wrong. You may have the numbers exactly right. It's just how you report it to the IRS. Unfortunately, there's a very roundabout way to do it. But Joseph's spot on. Yeah, I mean, anything over 2,500, we're probably going to capitalize. And for most of our content creators, you're looking at like a 5-year useful life for pretty much any item they have. That's what we see the most common. But he's right. You could get upwards to, it could be 7 years, or, we do have some content creators who own real estate and stuff like that. And then you're getting into a whole separate category. So, but for most creators, the equipment you have in your background, if it's over 2,500, or your PC, maybe not in the background, but those things, you're probably going to capitalize those items.
Great. Now we're getting pretty in the weeds about
Yeah.
specific stuff. So I kind of want to take a step back and talk about, you already mentioned, things get complicated enough, you want to bring in an accountant. I'm sure for a lot of your clients, you're the first accountants they've ever spoken with or worked with. I want to understand from your perspective, when you get a new client, the things that they should be doing in terms of adopting bookkeeping or record keeping strategies on their own, type of software that they should probably be looking into to make everybody's lives easier. And then the things that they should be doing throughout that first year working with you to make sure that come tax season, which we are now in the throes of, things are going to be a little bit easier. Make sure we get that filing on time. Maybe you can even avoid doing an extension, like I know I'm guilty of doing almost every single year.
Yeah, I'll kick this one off just because, again, the bookkeeping side of things and record keeping is right up my alley. The first things that we see is, so you're spot on, Adam, when you say a lot of times the first accountant they're talking to, if not the previous accountant was maybe an accountant that was a family friend and just asked for their 1099 each year. They weren't even writing any deductions off. So the first thing for us is going to be probably getting them on some sort of accounting software, like you said. It is a service that we provide. So a lot of times we're recommending that we handle this for them, of using something like QuickBooks. There's other ones out there like Xero, FreshBooks. There's a few different ones, but basically just some kind of record keeping software to where we can go back and capture the data from the prior year and make sure that, hey, we are going to try to get some of these deductions that we just were talking about. That's going to be our first step, right? That very rarely are we ever going to file a return just using the client's 1099 that they got from, let's say, YouTube, Twitch, or whatever platform they make revenue off of. That's going to be our number one thing. The next thing I would say is recommending to them to track it on their own if they're not already. This could be as simple as just using Excel and tracking month over month, downloading their bank statement. And okay, I had this many deposits. This is my income for the month. And then these are some of the deductions that my accountant told me I could be, tracking and writing off, even if it's just the most basic items. That's going to be like the best place to start. Garrett, I don't know if you have anything else to add to that, but that's where we're always going to start with our clients.
Yeah, over the years we've tried all the different softwares. I mean, at this point, we pretty much use QuickBooks predominantly for every client if we're setting them up. So if any client, if any non-client came and asked, like, hey, what do you recommend? QuickBooks is relatively straightforward and simple. That being said, as you grow, as you continue on your content journey, if you're just starting off, the transactional volume is very low. You're not going to have a lot of money coming in and out. As you continue to grow, though, it does get more and more complicated. That's when you probably want to look into hiring an accountant to maybe do the bookkeeping for you. But early on, like Joseph said, the lowest level is you're not doing anything. And then at your accountant, you get your bank statements every year and you just highlight things for your accountant, maybe. Okay. So that's like awful. That's going to be the hardest way to do things. The next step up is you use something like Microsoft Excel, start categorizing things. We, in fact, provide clients with an Excel spreadsheet, and we also have it in Google Sheets. That just helps them go through that. And it's got monthly columns, and then it has the common deductions that we see with our notes off to the side. If they want that, it's completely free. We just give it to them. Here, you can use this to help you start finding these items and categorizing everything. And then beyond that, that's when you kind of move into a QuickBooks type situation. So yeah, I mean, that's the early software. What if we're talking like S Corp and all that? We have other recommended softwares, but usually for your content creators just starting out, you're not going to have a payroll consideration. You're not going to have some of these other things. So you're just not there yet. As you continue to grow, it's very common you work your way into those other softwares. And then again, if you're working with an accountant, we can always make recommendations on basically like what we use, for example, if we're the ones doing it.
One more thing to add here is, and this could be also throwing it back to you, Adam, after this, is a lot of times too, what we're going to recommend once we've worked with somebody is getting an actual specific business bank account, right? A lot of the times that these creators come to us and we are the first accountant they've worked with, maybe let's say they're in that $50,000 earned a year to maybe even upwards of $200,000 earned a year. And they're in that small realm where they don't know what deductions and they're just getting with us. A lot of that time, those clients have everything mixed, right? It's all in their personal bank accounts, maybe just one bank account. Maybe they're using PayPal, maybe they have some credit cards, but it's probably all in their personal account. Our number one recommendation outside of, obviously tracking for accounting purposes and tax purposes is go get a separate bank account. And that usually is where we're calling Adam, because we're saying, hey, we don't have an LLC, so we don't have an EIN for that LLC, so we cannot go open a business bank account. And that's where we're throwing it back, to you to say, let's get this person set up. They're at the point where we need to start separating these things out, and really just cleaning it up to where all business is business and all personal is personal.
Yeah, yeah, and that's a good point. And when we work with creators, one of the first things we do suggest is, hey, let's form a loan out company for you at the very least, which is going to be technically a separate entity from you as a human being that's recognized as separate. It's usually going to be an LLC. Sometimes it's taxed differently, and I'm going to ask you guys about that in a minute. But actually, from the legal perspective, when you form an LLC, you're required to create that separate bank account in order for that LLC to be viewed as a separate entity. So yeah, you get a list from us of, hey, we're forming your LLC. Here are the things we need to do together in the first few weeks. Number 3 or 4 is always, once you get that EIN, form that separate bank account and make sure they are completely separate. Because while the accountants might be able to kind of differentiate between the two, if this ever gets litigated or sent to court, or even the IRS gets involved, we want it to be a lot cleaner than just in the books. We want it to actually be officially separate. On that note, since we are talking about LLCs, would love to hear your thoughts about company structures, S Corps, C Corps, LLCs, upsides, downsides.
Yeah, I'll take this one. So, when you have this, it's so common to we do have a lot of clients come to us and they're like, I already have an LLC, but what now? Right. And because oftentimes they maybe work with an attorney, they're like, I need to get this set up. And sometimes they do it on their own, which we don't recommend. We're like, hey, please use an attorney for this, because there's so it's advertised like, oh, just set up an LLC. It's super simple. It takes 5 minutes. And while yes, it can, depending on the Secretary of State website you're using, that doesn't mean it's done correctly. So getting with somebody like Adam, and then Adam sets up the LLC and we start going down the road there. After that, by default, so we clear the air here, by default, if there's only a single member, if it's just you creating content, which most of our creators are, you're not in a big partnership or in any type of entity like that. By default, you are a sole proprietor and you will file Schedule C on your 1040, even if you have an LLC. Because we have a lot of creators that come to me like, no, I have an LLC now. I'm like, yes, you do, but you are still, in fact, the IRS, they say their terminology that they use is disregarded entity. So even though you have an LLC, the IRS almost looks through that. They look past it and they say, yes, you have an LLC. That's great for legal reasons. For tax purposes, it means nothing to us. You're still going to file on Schedule C. If you want to go the S Corp route, which is very, very common with content creators, we get that question all the time. Like, hey, when should I swap to an S Corp? It's like, I don't know where the programming is coming from. Maybe tax TikTok or finance TikTok. I don't know. But once they hear that, they basically come and ask like, hey, when should I swap to an S Corp? In order to swap to an S Corp, it's actually incredibly simple. You file Form 2553. It's just an S election. And once you tell us we can do it, we can actually prep it. That genuinely literally takes like 20 minutes. We prep it, we get it ready, we send it to you, you sign it, we fax it to the IRS. And yes, I said fax. That's what we have to do. Sadly, this is the IRS we're talking about. So yes, we have to fax this in. But that is how you make an S election. From that point forward, you are now an S Corp. And there are a multitude of reasons why you might want to do it and why you might not. But before I go down that road, the only other thing I want to say here is if you do have multiple partners already, so when you form your LLC, there are multiple partners, by default, you are a partnership, and it's not because you're not a sole member, it's not on Schedule C anymore. You just by default have a partnership. You can still elect S Corp status, but it's important to point out that when you get your LLC, it doesn't change anything, right? It doesn't give you any extra deductions. It doesn't make you like, oh, I'm this big business entity now. Now, it doesn't do any of that. What it does do is it begins to separate out business from personal. But from a tax standpoint, you still get all the same deductions before you have the LLC and after you have the LLC. I just want to.
And before Garrett dives into the considerations or maybe when that threshold would apply, the funny part is when we're talking about electing to become an S Corp, that is sheerly from a tax perspective. And from the
Yes.
legal perspective, nothing has changed. You're still an LLC. You still have the same documents. You are not considered to be a corporation from like a liability or a corporate securities perspective at all. So
Right.
it's this funny disconnect where a client will come to me and go, I have an S corp, my accountant set it up, and we'll have to really look into what that means, because sometimes it means, yeah, there actually is a full corporation with bylaws and we have to adhere to a whole other set of rules. But other times it's actually meaningless to us as lawyers. But anyways, I am very curious to hear what the threshold is for making that election, because that's a question that I pass along to accountants all the time.
And just before you go, Garrett, to clear up what you said, is you could have an LLC and be a disregarded entity. You could have an LLC and be a partnership, or you could have an LLC and be an S corp. So just telling your accountant or your attorney, I have an LLC already, doesn't necessarily tell them how you file for taxes. So there's some nuance here. Just clearing the air there. Go ahead.
Yeah, it's hard to say, to talk through entity structure without getting in the weeds. But I will give, my best, I guess, very basic thresholds that we look at. So when we're looking at a client to make an S election, before we even have the conversation, a lot of times the first thing we're going to look at is income. Because I'll tell you this, if you're not, from a net income perspective, if you don't have at least somewhere between $80,000 to $100,000 of net income, we're probably not even going to bring it up. And the reason for that is any savings we may be able to generate from a tax standpoint by swapping to an S corp, it will probably cost us it will cost the client that amount for us to even do it and set it up and get it rolling with everything that they now need to do. Because once you have the S corp, you do have to worry about payroll, right? We have to have that separate business bank account. We have a lot of things that now, before we could have kind of pieced little things together as we were navigating and getting up to that point. Once you have the S corp, we need to kind of have it figured out. We need to have that separate business bank account, the bookkeeping, the payroll. We need to be, or at least be on the track there. So it costs money naturally, and we're never going to recommend that to a client, even if it saves them money. If it's going to cost that money, if it's going to cost them that money to pay us to do all the work, that doesn't make much sense. It's a lot of extra effort for not a lot in savings. Once you start to hit 80 to 100K in net income, that's when we're like, okay, it's starting to make sense. We're looking at potential savings here of like $8,000 to $10,000. We know our fee will come in below that. We feel good about that. We can actually save you money. And then from every year there on, you're probably looking at the same savings, provided that income is going to be about the same. Another consideration there, Adam, is we won't even recommend the S election if we don't think the client will be very responsive. If the client is very hit or miss and is just not going to communicate with us well, once you have the S corp, it's sticky. It's not something you're just in and out of every year. You can't just make the election and then kind of disregard it. You have to pay attention to it. And if we feel that a client is not going to be up to the task there, we honestly may not recommend it. Well,
what does that mean? What do you mean by up to the task? What do they have to do?
Can I take this, Garrett?
Yeah, take it. Yeah.
So Adam, what it means is that there's a certain level of communication that is required in order to essentially ensure that this S corp is kept up correctly. And we can only do so much as your accountant, just as you know, as their attorney. You can only do what you can do unless the client's cooperating with you. And those levels of communication for each client just varies, right? The number one is going to be that payroll that Garrett spoke of, not only running the payroll, but getting it set up, right? There's things we have to jump through. We need client signatures. Even on the S corp form, we need client signatures, and it has to be an actual pen to paper, wet signature on the form. So these types of things, sometimes as small as they may seem, it's very challenging to get a client to print that out and get it back to us, especially when you could be talking about a creator who's 21, 22 years old. They've never heard of a tax form in their life, and you're telling them, I need you to print this and sign it and get it back to me. Those are the types of things that we see, and we don't want to put a client in a position where we've set all this up and basically are haggling them to get it done, and they don't really even understand the benefits or, why we're going about it.
I guess, like,
Absolutely.
speaking of things that are required, what practices, on a more bigger picture, but what kind of practices can artists adopt to minimize the risk of raising red flags of any potential audits with the IRS? Like you had said that, there's certain things that have to happen with an S corp. Like, what are other things that have to happen to avoid the risk of audit?
listening. So this sounds so silly when I say it, listening to your accountant, but I don't mean it from the standpoint of like, just do what I say. No, I mean, again, going back to communication, in a lot of cases, we're trying to do things in a timely manner to prevent that. And once, for example, if you receive an IRS notice, generally the IRS will give you 30 days to respond. We want to respond in 30 days. And if I have to, we have to go back and forth, I have to go back and forth with a client, like, okay, we can probably get this taken care of, but I need this document and this document. This is what they're asking for, right? And the client doesn't respond, and they're all of a sudden now we're at day 29 and they send it back and they're like, can you knock this out? I'm like, well, it's like you gave me one day to generate a letter and do all this other stuff. That's the first thing I'll say is communication. And over and above that, really, if you're working with an accountant, you're not going to have too much, hopefully you're not going to have too much to worry about because your accountant's going to be checking the books, right? So the common deductions or the common gray areas Joseph referred to earlier, if you're trying to deduct $50,000 of meals and you're a content creator, it's very unlikely that you're meeting with clients and networking and doing all those things, not to the tune of $50,000, right? And so if you show that on your return, you're kind of inviting the IRS to come in and say, like, because what the IRS does on the back end is they run percentages, and they say for this type of industry, depending on there's an NAICS code is what it's called. For this industry that this content creator's in, we typically see meals be 10% of their revenue, right? So anybody who's over that, it's not necessarily that the IRS is going to come and audit you, but it is what you might call a red flag, right? So if you're going way over and above, now that doesn't mean it's not substantiated. There could be a very valid reason, but we look at those things. And so between deductions, between communication with your accountant, constant, especially during tax season when you're trying to get the returns filed. And Joseph, help me out if I'm missing anything here, but those are the items that we see cause the most issues. Over and above that, obviously, if you just ignore, we've had situations where clients have come in and asked us to clean up their tax situation for multiple years. If you're ignoring tax returns and notices for multiple years, even when you get it cleaned up, you may be inviting an audit because now that you've cleaned it all up, it may not jive with what their computer system has. And it's just now you have multiple years of incorrect tax returns all filed at one time. It's not ideal. So
one of the most common red flags Garrett didn't mention there, just because we were on the S corp topic, is becoming an S corp and not filing a payroll, not running payroll.
Yeah.
Which we do, which has happened before. We do S election. Let's say in August, we say, hey, we need to get your payroll set up and ran. Client goes to us. We don't talk to them the rest of the year. We don't run payroll. Now they are an S corp filing tax return as an S corp with no owner's salary, no owner's payroll on there. That's going to be one that, correct me if I'm wrong, Garrett, but I'm pretty sure the IRS has never lost an audit against that whenever they audit an owner. And what they inevitably will do is take all the distributions that you classified, which is where you pulled money out of the company, and they'll basically tax you on that as income to you. So that's probably one of the most biggest ones we see. But as Garrett said, just general compliance, working with an accountant that's going to advise you accordingly and actually listening to them.
Since we have the attorneys, I will say, yes, case law studies, it's proven that if the IRS wants to reclass those distributions, they have a 100% win rate in tax court. They have never lost a case where they were reclassing distributions if the owner didn't run any salary at all. And that's the thing, is now we're playing with very real stakes, because if you have 100K in distributions and they reclass all of that to wages, you're not just looking at an income tax component there. You're also actually looking at back payroll taxes, because you were supposed to run payroll reports for those time periods and those were all wrong now. It's a very sticky situation, and that's why we don't recommend it unless you're actually going to truly work with an accountant, and honestly an attorney too, because beyond that, the IRS will look through that and say, let me see your minutes, right? Let me see your board minutes. Let me see your articles of organization. Let me see all these things that you have, since you say you have an S corp, right? And so for our records, we don't prepare a lot of those things, but we go to somebody like Adam and say, hey, can you send us these documents from this client? And if Adam can't provide it, we're like, oh man, this client's probably not responding to him either, right? So Yeah,
And that goes to your earlier point about if you're going to form a company and you want to use like one of those online services, make sure you know what you're doing because they are not going to prepare a proper operating agreement or bylaws for you. That is something that you actually have to work on. There's no one size fits all template that's going to be auto-generated for you quite yet. But with that, I want to ask one more question before we open this up to the chat, just because it's something that's been popping up in my world a lot more in the last couple of years, and I have a feeling we're going to see more of it than ever. It's content creators getting outside investments, whether it's from brands or private individuals, to fund their projects, to basically go to the next level, make bigger projects, whether it's long format video that they're going to release on YouTube, or maybe even sell to a streaming station, or music videos or collaborations with other creators that they maybe haven't been doing. I want to understand sort of the tax implications of taking on a major investment or sponsorship money from a brand that isn't necessarily just for a specific campaign, but is for a larger project.
Yeah, I will say the first thing we want to do is delineate between, is this an investment in the sense that now this whatever entity that is giving you the money, are they becoming a part owner in your brand and what you're doing? Or are they truly, is it a sponsorship where they're paying you as a contractor to do some kind of, it could be, anything, any kind of campaign or something like that. So I would delineate between the two first. I would say, is this truly an investment? They're putting money into your business with an expectation they're going to own it, or are they just sponsoring you? Is this like a brand deal, basically? Once you're past that, if it's a brand deal and you have a lot of income coming in, then naturally we're going to do our absolute best to track the associated expenses. That goes back to everything we've talked about before. If it is an investment, especially if it's outside investment from maybe like a foreign entity, which to your point, Adam, that is popping up more and more, that complicates things in a whole nother realm. Because, for example, if you have an S corporation, you can't have a foreign shareholder. So if that entity wants to invest in you, then an S corporation, that's a good reason why an S corporation may not be a good entity structure for you if you think that's going to be a possible future occurrence. In addition to that, if you have a foreign investor and you have something like a partnership, your partnership return just went from probably just reasonably like we could do it before 415 to this just got a lot more complex, because with a foreign investor you may have mandatory withholdings from the IRS, and there are all kinds of other considerations there, because ultimately the IRS doesn't trust that you're going to pay any money that you're supposed to pay. And when you involve a foreign individual where they don't have a social or an ITIN and the IRS can't track them, they don't like that. They're like, well, okay, well, you're just going to have to, we're going to force you to pay us money up front because we don't trust you're going to pay us in the end. So it gets way more complicated. It's popping up more, but that is still very rare. You're only going to typically see that with your higher end creators. If you're a creator that's just starting out, what we're probably talking about is what you said. It's probably a sponsorship or a brand deal, in which case it's just income to you the same way your platform income. It's going to be treated the same as your platform income. So
I would say this too, just to tag on the back end. If you find yourself in a situation where you're being offered an investment into your company, as Garrett was speaking of, and you aren't talking with someone like Adam or ourselves, those are the people that need to be on those calls with you before you ever say, I'm signing the dotted line with this contract. Because if you're giving away a percentage of your company, there's obviously, as Garrett said, there's major impacts there. And we just want to make sure we're advising our creators accordingly. So I'm sure, Adam, you would be terrified if you had somebody come to you and tell you that they did that without talking to you first.
I'm sure somebody has probably in the past.
I see that unfortunately every few months, where you'll have a young creator who's doing really well for themselves, and you get somebody who maybe has a few more years on them in business and goes, "Hey, give me 50% of your company for, I don't know, $40,000 or something," and not papered well, and it sort of leaves the creator stuck with this person essentially married to them indefinitely. So certainly, if that situation does arise, you have a professional in your corner. Make sure you let them know first, see what their response is, and then kind of work from there. Whether it's an accountant who's going to say, yeah, time to bring in a lawyer to start negotiating this properly, or if it's a lawyer who's going to say, okay, terms sound all right, but make sure we're doing this on the finance side properly, let's bring in an accountant. You want somebody in your corner for that, because that will have further reaching implications than any single brand deal you ever work on.
One
Cool.
other thing too, just is we've seen kind of the opposite as well with some of our large creators where they actually were given shares in a company early on, grew together, and now we either have disagreements or we're just splitting ways and going different ways. And maybe there was no basis information tracked on those shares. Maybe all these types of things, which obviously, as you know, Adam, it can create very large tax implications there. So just if you're doing outside deals that you're unsure of, or your approach with these as a creator, please seek professional help in some way, shape, or form. If it's Adam, hit him up. He'll direct you. If it's us, hit us up. We'll direct you.
Cool. Well, with that, we've got about 10, 15 minutes left. The chat should be open. So I'm going to invite everybody who's been sitting here for the last 45 minutes or so, please, if you have any questions for Garrett or Joseph, type it in and let's see what they have to say. Put them on the spot, make them hard, tough questions. I want to see them squirm a little bit in their chairs.
I'm waiting for Paul. Hopefully, I hope it's okay if I call you Paul. But I see the Weissman last name. I'm like, oh, I can't wait to hear what he has for us. But I will say it's funny. There we go. Awesome content. Thank you.
Thank you.
While we're waiting for the questions to come in, I just wanted to say it's very, if you get a bunch of attorneys on, it's kind of like when you ask your barber, when should I get a haircut? What's the barber going to say? Like right now, there's never a bad time. We probably advocate more for attorneys than the attorneys themselves do, because we know how bad it gets once a contract, for example, is not reviewed. It is awful. It's not a fun experience. While attorneys cost money, just like accountants cost money, it's going to cost you way more in the long term if you don't have somebody in your corner reviewing that stuff for you. And I've seen it happen. I've actually seen it personally with Adam reviewing contracts for clients. But just in general, especially in the space with the amount of brand deals that are going on, contracts are like paramount to everything. And if you're not having somebody look those things over, it is a big deal. I mean, you could be losing out on a ton of money, or at least leaving it on the table if you're not having somebody review that stuff. So definitely go get you somebody. Like somebody needs to be looking at that stuff.
And there's certainly a bunch of us out there, but I will say that's great advice. And I think particularly in the creator industry, there's we're still a new industry. It's been around, maybe 10 years, a little bit more if you're being generous. So if you work in the other entertainment industries, I'll say there's already a concept of like, you get your lawyer, get your accountant, you get your financial advisor, you get your agent, et cetera, et cetera. That's still figuring itself out in the creator space to some degree. So talk to folks who have experience in the space, get acquainted with them, and realize that like chatting with somebody like Garrett or Joseph is probably not as scary as it seems ahead of time. Not seeing too many questions in the chat. So I know Lorena prepped a few for us. Why don't you ask?
Okay. So Joe, this is for you, since earlier you were talking about kind of travel and education. I was just wondering if you could provide some examples of like what kind of travel or education expenses creatives often overlook that they could claim as tax deductions. And then in addition to that, if it's a second question, but I'm going to build on. So for artists who might be considering either giving workshops or teaching, how does this income affect kind of how they do their taxes, or if anything?
For sure. That's great. Those are great questions. Yeah. I definitely think too many times people are not capturing the travel expense they have. They're just assuming automatically, well, this is going to end up being personal. So even if they have separate accounts, they're putting that on their personal account, their flight and all this stuff. It kind of goes back to our original deduction conversation, right? It does need to be ordinary and necessary to do your job. That being said, there is a long list of items that we can write off when it comes to travel expenses, right? Anything, flights, lodging, Ubers, taxis, any type of stuff like that. Even down to like the meals that are going to be associated on this business travel, right? For our creators, a lot of times the way this plays out is going to be conventions they go to, TwitchCon, VidCon, DreamHack, things like this, where they're networking, right? They're meeting other creators. They are there for business. They may be consuming the content of the conference and personally enjoying it, but it is for their brand, right? Even if they're not being paid to go there. So anything like that is generally speaking going to be the events we see. Sometimes if you get into the esports side, obviously the esports tournaments. any expense that's directly related to that travel, if it is related to your business, we're going to write that off. Now, where it gets a little bit tricky is going to be if there's business and personal use. And then we just kind of take it nuanced there, right? We would just look at the total travel cost after the event and pull out some of the items if they were personal. We're able to kind of do that. And so we would always recommend basically classifying as much of that as business expenses as we can. And then we can go back and pull some out after the fact. And then to your second question, remind me again what exactly it was.
Oh, so like for artists or who might be considering teaching or giving any sort of workshops, how does this income affect their taxes, if in any
Sure.
way?
Sure. That's great. Yeah. So we actually have a few creators that we work with that started creating content on their own and shifted almost their entire business model into selling educational content, and have subscription revenue now that has almost shifted to be their main revenue source. So it would just end up being picked up as ordinary income in the same way. That being said, what I would always go to the client and ask is this something we are trying to shift as it's kind of a second revenue source? And if so, it could potentially, depending on how large scale it's going to be, need to be in its own separate entity. If we're doing completely different, basically styles of services, then we may not want them in the same entity. So that would be the only other consideration there. Otherwise, if it's just on the side, people doing social media management on the side for people, even though they obviously are a creator themselves, things like that, it's going to get picked up as ordinary income. But great question.
Thank you.
Do we want to hit Paul's question in chat?
Let's do it. May have missed it. What support needs to be retained and for how long in order to write off expenses?
Okay, Joseph, can I have this one? You took all the other ones. You took the fun one. So this is a bookkeeping thing for the most part, but it does play into tax if you get audited. Like how, what do we need to show? Receipts, yeah, those are great source documents. You don't have to keep them though. If you have, typically speaking, any audit that I've actually been a part of, they are willing to accept bank and credit card statements if the data on the statements shows us basically what the transaction is. And a good example is you go to TwitchCon, like Joseph said, you can easily show on the bank statement that you paid for a flight. Here's the hotel expense. Here's the ticket to TwitchCon, so on and so forth. And that could be any event. So ideally, if you're a larger creator and you're making decent amount of money, you're paying for bookkeeping. As long as you have good books, and then as long as you have those bank statements to support the transactions that you have going in and out of your business, you're good. And so basically what I'm saying is you don't have to keep every receipt in a shoebox like, this was the 70s. You don't have to do that anymore. And how long in order to write off expenses? That's a good question. So the statute of limitations, technically the IRS can go back most of the time. Statute of limitations applies. We keep records for 7 years. So basically, if you haven't filed a tax return in 7 years, we could always go back, file those returns and put those expenses on. After 7 years, for example, we get rid of our documentation once it's 7 years old because we are not required to keep it anymore. The only time that's not the case is if you're committing fraud. So if you're committing fraud, don't do that.
Don't commit fraud.
Yeah, don't commit fraud. If you take anything else,
I think that's
but outside of that, you can technically you can claim a refund for up to 3 years. So right now, I think it's actually I want to say it's the 2022 tax year looking at it. You can claim a refund for 22, 23, and 24. Yeah. So if you have a refund sitting out there, go get it now. But as far as expenses and how long do you have to write them off? 7 years, typically speaking. If you have tax returns older than that, then pray the IRS doesn't find you. I don't know. Am I allowed to say that?
That one I'm hearing is you can throw out those shoe boxes full of receipts from 2017. I think you're safe.
That's right. Yes.
All right. I think with that, we're gonna leave it. I really want to thank Joseph and Garrett. Oh, we have one more question. This is from Jake Johnson down in Austin, Texas. Thoughts on which retirement plans to use, SEP versus 401k?
SEP is the easiest one. I'll quick hit this because we were trying to get out. SEP is the easiest one to set up. That's very quick setup. 401k, if you're going to set that up for your business, there's a little bit more of a filing requirement on the back end. technically, if you have a solo 401k, at the end of the day, you can eke out more in a contribution. So you can do like a defined benefit, or not defined, cash. Now I'm blanking on the name of it, and I'm the accountant. The 401k, ultimately, you might save more money, but the SEP is the easiest one to set up, and it still gives you, typically speaking, a very large deduction. So most of the time, we recommend a SEP.
That being said, we are not financial advisors, and if we get into that conversation, we're always gonna just refer that out to one of our great financial advisors that we have.
From a tax, yeah.
I happen to know that the guy who just asked that question is a financial advisor, so there you go.
Yeah.
But I see one more question. Popular ways content creators use qualified or non-qualified benefit programs to prepare for what we hear the biggest fear of what happens if this income doesn't continue forever.
That is a great question. Hold on, I'm rereading that. Qualified or non-qualified benefit programs to prepare for what we hear as the biggest fear of what happens if this income. Yeah, he put cash balance. So that's a great question. Honestly, I'm misunderstanding if from the standpoint of, are we talking about the income itself, or are we talking about tax going away altogether with Trump's new potential tax? Is that what you're hinting at? And I apologize if I'm just misunderstanding this, but
sounds like more so, Garrett, just if their content creation income is just volatile and it falls off over time, what ways are we kind of preparing for that, is what it sounds like to me.
Yeah, if it's really volatile, I mean, you're not going to have a problem with just keeping the SEP in the background. Also, there are always the options of potentially a traditional or Roth IRA in the background too. Those contribution limits are much lower, but they're not bad by any stretch of the imagination. You're only looking at putting 7,000 away potentially, and if your income is volatile, it's those in fact may be better, because you just, if your income's down one year, you just contribute to that one. And if it happens to be up, you can obviously max that one out. So I will say that the SEP is still not a bad idea altogether, even for creators whose income is volatile, because you can always just leave it in the background. You're not required to contribute to it. I hope that answers it. Alex, if you want to reach out like after the fact, I'm happy to like discuss that more specifically, but I apologize. I feel like I can't really answer that one without a little bit more detail.
For sure. All right, I'll put you guys in touch later. But with that, I think I'm going to just end this thanking Joseph and Garrett for joining. This was fantastic. Really appreciated spending this last hour with you and going through all this complicated but accessible information. We have recorded this session, so if you would like to watch it again, make sure you sign up to the Weissman Law newsletter. We'll be sending it out probably next week or the week after. And if you have any questions about anything discussed today, feel free to reach out to Lorraine or myself, or likewise with Garrett and Joseph. We'll have their information in our next newsletter as well, so you'll be able to get that there. But I appreciate you all coming, and we will see you next month at our next webinar. Take care and have a great one.
Thanks so much, guys.
Thank you all.